Suppose our company, Patriot Theaters, which owns and operates movie theaters through the Mid-Atlantic in Pennsylvania, in Maryland, Virginia, Delaware, they've identified a project where they want to expand into New England. The problem is they need money. It requires more money than they can generate just from their current operations, more money than they have in the bank. So they need to go out and get more. One way that they can do that is by selling or issuing equity or stock. So one of the ways that they can go out there is by selling stock. Primary market for stock, primary market for any asset, is the sale of new securities. And so basically what that involves is the company raising the money by selling shares to investors. So the company wants to raise money, they've got stock. When they sell that to the investors and the investors give them money, that's the primary market. Secondary market, that's the market where previously issued securities are traded. So once the securities go in the investor's hands because of a primary market transaction, then investors can trade amongst themselves. As it says here, the vast majority, that should really be the vast majority of stock trading activity takes place on the secondary market. That's where shares are exchanged among investors. So a share goes into the primary market one time, and then it's an unlimited number of times that it can bounce around among shareholders. When a transaction takes place on the secondary market, the company gets no money. One investor has the shares, sells them to another investor, so one investor gets money and the other gets shares. And there's exchanges and mechanisms for handling all this, but the bottom line is all the money and shares transact and are exchanged among investors. The company is out of the loop in the secondary market. There's two kinds of equity. There's common equity and preferred equity. Let's take a look at common equity first, some key characteristics. It is an ownership interest in the corporation. So basically, if a company issues a certain number of shares, let's say 1 million shares, every share that somebody owns, 1 million ownership share. So if you have a company that's got 10 million shares out there and you own 1 million shares, you own 10% of that company. Common stockholders, they run the company. Typically it's done indirectly, but nonetheless they do run the company. They elect a board of directors, and the board of directors appoint senior managers. Occasionally the stockholders will vote on real big issues like should they get acquired or should they engage in a very large merger. But by and large they run the company, but they do it indirectly. Fancy expression, common shareholders have a claim on all residual cash flows. So one way to think about it is if there's a line and the firm, there's a window at the firm and everyone lines up in priority. The front of the line is the employers, the suppliers, the government to collect taxes. Then you get to the investors, and the lenders are at the front of the investor line, and at the very back of the line are the shareholders, which means that stocks tend to be risky because they have the last claim, which means that if the firm runs out of money before they get to the end of the line, the shareholders wind up with nothing. On the flip side, there's the opportunity for substantial gains and substantial losses because, like I just said, you can get nothing, but you can also get big gains. Because if the firm's got tons and tons and tons of money, then they are going to pay the employees, the suppliers are going to get to the bondholders. They're only going to pay them the coupons that they owe them. They don't say thanks for lending us money. You can have more than the coupon. And if there's lots and lots and lots of money left, the shareholders get that. So that creates a lot of volatility in stocks because you can wind up with nothing or very little, and you can also wind up with lots and lots and lots. Common equity has no maturity, so it can exist forever. It's sold out there. It doesn't have a maturity. It just exists. Unless the firm takes some special steps, like goes out of business or is dissolved because of a merger and acquisition, the equity will just continue to exist forever. Common shares often pay dividends. Those are just cash payments to shareholders. It's one of the ways that shareholders get a return is that the firm will regularly pay them dividends. One of the things about dividends is the firms are not legally required to make dividend payments. So what happens is generally every quarter the board of directors will get together and they'll decide whether or not to pay a dividend, and if they do pay a dividend, how much. And suppose they say, sorry, we can't pay a dividend this quarter either because we don't have enough money or we have better uses of those monies. There's no legal recourse that shareholders have. They can replace the board when, using the proper mechanics that are there, but they can't say, you owe us money, we're going to get paid, you have to pay us. There's nothing that can force them to do that. Unlike with bonds, where those coupon payments better get paid, and if they're not, that's a very, very big deal. Like I said, dividends are generally paid quarterly, and the board gets together and decides what, if anything, that's going to be. Common dividends frequently change over time, and they can change in both directions because they generally reflect company performance. When the company does well or grows, they'll increase. That's one of the reasons why people buy common stock, is the hope that if the firm does well, they can increase dividends and increase that cash flow to the investors. On the other hand, when the firm does poorly, they can be cut. They can be cut to zero, but they can't be negative. Zero just means the board says, sorry, the firm can't pay you anything, or they can be positive. But they can change in both directions depending on how the firm is doing. And they're not tax deductible. So when a firm pays dividends, they don't get to treat that as an expense. How about preferred equity? First of all, it's relatively rare. Most companies that issue stock do not issue preferred stock, and companies that issue preferred stock tend to issue common stock as well, and they tend to issue more common stock than preferred stock. So it's quite rare. I shouldn't say quite rare, it's relatively rare. Preferred stockholders have limited say in running the company. Very few voting rights, so they don't run the company. Who runs the company? The common shareholders. One of the characteristics of preferred stock is that it's like common stock, in which firms are not legally required to make dividend payments. So if the firm can't pay the dividend, there's no legal recourse for preferred shareholders to say, hey, wait a minute, we demand our money and we're going to force you to pay us. Preferred dividends can, but generally don't, change over time. And so this gives you, we're going to talk about some things now that make preferred shares something that's attractive. We've talked about what they can't do. They don't have voting rights. They can't get forced to pay dividends. So preferred dividends, they're often set at a stated amount. So when preferred shares are initially sold to the public, either as kind of a percent of book value or as a dollar amount, they're sold with the expectation of a fixed dividend forever and ever and ever. It might be $5 every quarter. It's $5 per year, so every quarter the preferred shares are expected to pay $1.25. If the firm does very, very well and is just rolling in money, those preferred dividends do not increase. So they're like coupons in that sense. However, when the firm does poorly, they can be cut, and sometimes they are cut. However, if they're cut, there are some conditions, some implications. First of all, if preferred dividends aren't paid, common dividends can't be paid. So the firm can't do things that are advantageous to the common shareholders unless they have already done everything that they've promised to the preferred shareholders. And one of the more interesting characteristics is preferred shares are often cumulative, which means that suppose this period, the preferred share, let's say it's a $2 every quarter preferred dividend. So the firm says, I'm sorry, we can't pay our preferred shareholders $2. So they're not able to pay the $2. So they can't pay anything to the common shareholders. The next quarter comes along and they owe $2 to the preferred share holders. But now they actually kind of have four. They have the old two and the new two. Until they get $4, till it's cumulative, such that kind of the amount owed accumulates, common shareholders can't be paid. So once a firm is unable to meet its preferred obligations, then basically one way to think about it is the common shareholders basically need to sit down until the preferred shareholders catch up. And again, preferred equity has no maturity, so it can exist forever. So basically we're looking at an equity that has a dividend that's expected to remain constant forever and ever and ever and ever. Priority of claims. So we have our line out the door, or at the window of the firm, and in the front you got the employees and the suppliers, and then you get your investors. And who's at the front? The front one is the bondholders, and the preferred shareholders are near the back of the line. So basically they have a lower priority than the bondholders and a higher priority than common shareholders. So it goes so here, if here's the window, here's all those other people, then you get to the investors, so you have the bondholders, the preferred shareholders, and then the common shareholders. Therefore, we have the same order of risk. Preferred equity is considered less risky than common stock, but more risky than bonds. So for the typical firm, and so this is for a firm, if you're comparing bonds of one firm to common stocks of another, you can't necessarily conclude that the common stock is riskier than the bonds. But for a typical firm, the expected return for its common equity is going to be greater than that for its preferred equity, which is going to be greater than its yield to maturity on its bond. So if you want to invest in a company, the most risky way to do it is by buying common equity. The least risky, the one that can give you the highest expected, the least risky, the lowest expected return is bonds, and preferred equity is in the middle. Again, the terms equity and stock refer to common equity unless explicitly noted. In most cases, it doesn't matter. Shareholders, that refers to, the owners of the common shares. In most cases, it doesn't matter, but there's a distinction. If necessary, that's an assumption to make. Also, we're going to assume the next dividends in one period. In practice, if it's paid every 3 months, then only 4 times a year do you get a dividend that's due in 3 months. But let's say the next dividend is due in 1 month, and 4 months, and 7 months. The steps that we're going to learn and do would give us the value at the stock as if it were 3 months, and then we have to make another adjustment, assuming that that next dividend is in 1 month. So we're getting the basics by making this simplified assumption. And again, if the next dividend is due in 3 months, then assume it's quarterly. Don't assume, it could be 3, then 15, then 27, then 39 months. Now, if it's next in 3, assume it's quarterly. And if it's next in 12, again, assume it's annual. Companies can sell different classes of shares that have different voting rights or dividend payments. So this is a common technique used by families or initial owners to maintain control. So for example, Facebook stock has 2 classes. The class that's out in the public has 1 vote per share. The class that the original owners and the founders have 10 votes per share. Ford Motor Company, New York Times with the ownership family, Cablevision with the Dolan family. There's a lot of companies that are like this, where the founding families, the founders, have shares that have higher voting rights. They often have smaller dividends, but it allows them to maintain control. The other thing is companies can sell stock issues repeatedly. So suppose a company goes out and sells 500,000 shares of common equity, and then 2 years later goes out and sells another 500,000 shares of common equity. There's now 1 million shares, and it doesn't matter whether you have a quote unquote new share or old share or quote unquote new share. A share is a share. So if you own 1 share, you would own 1/1 millionth of the company.